Harsha Upadhyaya joins us. Harsha, good morning. Thank you for joining us. Harsha, what has changed for markets post-budget? Nothing came in the budget which could be called as exciting. If at all, there is a compromise on the fiscal and there is nothing great which will stroke the growth. Yet markets have been on a different trajectory post-budget.
Good morning, Nikunj. I think market participants were looking for some uptick in profit after tax of the corporate India. I think that's come through. While at the sales level, the growth is still very, very muted and subdued, but we have seen some improvement at the margins, and thanks to the tax rate cut, we have also seen improvement at the profitability. So I think that's something which is positive. And secondly, I think global liquidity is clearly driving the markets. We got about $1.5 billion from foreign investments in the month of January. That was before the budgets. Post budgets, we have seen almost $2 billion coming in the next 15 days or so. At the same time, the domestic industry has also seen about $1 billion of inflows. So I think clearly, while some of the big events may be behind us, the liquidity is continuing to be very strong, and that's what seems to be driving the markets in the very short term.
As what you're trying to make it sound, that get them in the morning, look at flows and then take a market view, because if you are making a view based on fundamentals and valuations, you're not making money and you're not enjoying the market rally. I mean, DMart was expensive, but it has still made money. When I ask people why, they said it's liquidity. What do we do?
Yes, liquidity is driving some of the stocks which have been showing steady earnings growth to newer highs. But at the same time, there are also stocks which have done well, where immediately there may not be any turnaround in terms of earnings. But the expectation is over the next few quarters, things would turn around. And that's where we have seen money flowing in as well. Just to give an example, this is the first time in the last 2 years, starting January 2018 peak, for the first time when the markets fell just before the budget or in and around the budget, mid and small cap basket didn't really underperform the large cap basket. So to an extent, while the flows have been still going into the same names in the large cap category, we have also seen money moving into mid and small caps and giving some stability. And that's where we believe the valuation cushion is there. One can't wish away the fact that liquidity will not drive large caps in the short term, given the market narrowness, and also in terms of businesses, there are very few businesses which are really growing. But eventually, for the long-term investor, I think money can be made in the broader market, not just in the 20-40 handful of large caps.
Harsha, what happens to Telecom as a story? Do you think it's all in the price? The fact that they're going to be making the AGR dues, at least that is what the DOT sources seem to be telling us, or do you think there is more by way of a price movement that we're likely to see? Perhaps some more gains for Bharti, more losses for Idea?
Aisha, clearly the telecom industry is in a flux. After last week's Supreme Court judgment, it is very clear that AGR payments will have to be made. Yes, the companies are in the process of making those payments and also making a self-assessment. We really do not know what the final number would be. That's point number one. Whether that will lead to change in the industry structure, I think clearly it will, because the market leader may continue to consolidate given that the cash flow pressures would be there at other players' end. We will also have to see how the banking sector exposure is taken care of, because not all of the banking sector exposure is provided for, since it's a standard asset in the banks. So we need to see how the banking system would respond to it, and also we need to see what happens to some of the infrastructure players or ancillaries which are supporting the telecom industry. Again, there would be change in their business performance as well. So overall, the industry is clearly in a flux, and we have preferred to play that through the market leader rather than jumping into some of the beaten down names.
Okay, Harsha, the bigger concern you think is for banks which have telecom exposure. While it may be well in the price for telecom stocks, as I see right now, banks could be a little bit of a problem area. I mean, SBI has almost 5.6% of its net worth as an exposure to telecom. IDBI Bank has one of the biggest exposure, almost 6% of its loans to telecom. IndusInd Bank, ICICI Bank, PNB, Yes Bank, all have large exposure.
Yes, clearly, if that exposure is not provided for, in many cases it is not, then obviously there is going to be further pressure in terms of profitability of some of these banks. And the question again remains that whether there is adequate capital available for some of these banks to provide for these losses and continue the business in the normal course. I think that's where clearly we believe that public sector banks will still have issues to contend with, and we prefer to play that through private sector, and especially the ones where the telecom exposure is either nil or at manageable levels.
So for someone who says, look, what is on the table now? You're buying a market which is not cheap. You are looking at pockets which are priced to perfection where earnings growth is there. So someone who's looking at investing, what is the upside now? Because for the longest time, Harsha, everyone has argued on this forum that bet on the economic recovery, buy industrials, buy cement, buy steel, buy engineering. Those trades have not made money.
Nikunj, partly that is true, but in some cases I don't agree with you completely. For example, cement, where we have been overweight, the sector has done quite well. Yes, the volume growth could have been better than what we have seen in the recent past, but it is still one of the areas where there is volume growth. The pricing scenario has really been very, very strong, given that the industry has seen consolidation, and we have seen the stocks doing much better than the overall market. That is one of the industries where I think on a non-consumption side, things have really turned out well. And our expectation is even in industry segments such as engineering, cap goods, over a period of time, that will definitely outperform the consumption sector, in our opinion, because the valuation differential is very, very large. And once we see some stability in terms of order flows and execution, you're going to see much better stock performance in those segments of infrastructure or closely linked to economic activity kind of sectors. So our take on the markets is, yes, markets have remained expensive for a basket which has been growing steadily. More money has gravitated towards this basket. We do have some position in that basket, but increasingly over the last couple of quarters, we have been moving away from that basket, which means that our investments have gone into non-consumption sectors and also towards mid and small caps. So if you look across our portfolios, wherever the investment mandate allows, the mid and small cap exposure has gone up. It's not that things are going to improve in a V-shaped manner and we are going to see strong earnings growth in some of these mid and small cap companies. But if there are structurally good businesses and if there are cyclical headwinds, and if we believe that those cyclical headwinds will go away, then there is merit in investing in some of those given the relative valuation comfort. And that's what we have been doing.
Harsha, is there merit in buying any of the realty players? I mean, news just this morning, the fact that DLF is looking at selling a 2,000 crore rupee commercial land parcel. Selectively, would you say that real estate A has held out as well, irrespective of what the dynamics of the sector may be, but things may be just turning around?
Real estate from a stock market performance perspective has done quite well. We do have some stock specific positions, but we don't have a great sectoral comfort in real estate, given that I mean each company has a different inventory level. They are operating in different markets. The mix of residential commercial is different for different companies. So overall we do have some positions in real estate sector which has done quite okay in this period. But to take a broad sectoral view, I think the valuations are not to our comfort at this point of time.
So, Harsha, I come back to very basic question. How much more upside is left in the Bajaj Finance and the DMarts of the world? They are expensive, but yet they are making money. Now, an investor would say, look, you know, I don't care whether they are expensive or they are cheap. If my net worth is going higher, I love those stocks. I don't care, and I don't like whether cement and steel is cheap or NTPC has value. If my net worth is not going higher or if my investments are not going higher, I don't like those stocks. It's as simple as that. When do you think this circle will change, or do you think this circle of focusing towards quality will only intensify?
Nikunj, I would not like to comment on those individual stocks that you mentioned, but our thesis has been Yes, over a period of time, money, especially the incremental money, will move towards some of the not so expensive names. But today, when we look at earnings trajectory, not all of the sectors, not all of the businesses are giving the same comfort. So to that extent, as the liquidity comes into the market, it may still go into some of the names where there is a bit of a comfort in terms of earnings growth. The valuations may be expensive, they may get even more expensive. But obviously the margin of safety as it moves up is going to be less, and that's what we are also worried about. And if you look at our portfolios over the last 2-3 quarters, as I mentioned earlier, we have not been putting incremental money into the same names where there has been a reasonable degree of steadiness in terms of earnings growth, because we find valuations to be expensive. Now the question is, when will the other basket do well? I don't think it's going to be overnight. We know that economic growth is still sluggish. So to that extent, we may not really see an upside, because even if you were to see some liquidity flowing in, it's going to be patchy in that segment. But I think there are already signs that some of the segments are doing well, both in terms of business as well as stock performance. And we expect that number of stocks which are doing well in the non-consumption sector to grow over a period of time. So our guess is when you look back at the markets, maybe 2 to 3 years from now, it would be very clear that non-consumption basket has given more returns than consumption basket.
Right. Okay, just want to take a look at what else is happening in the market. Idea sure is rebounding, but I would say you could ignore this rate because we've not even made it back to that 4 rupee per share mark. There's Muthoot, which is holding out, Balkrishna Industries, Manappuram, as well as PFC, which is looking good right now. On the flip side, LIC Housing Finance, after its earnings, that's taking a whack of about almost 11%. There's Yes Bank, which is lower by about almost 6%. Sun TV, Gale, as well as BOB, which are part of the losers, down about almost 3% or so. The broader market also, remember, it's managed to snap its 8-week rally just last week after its underperformance. And today as well, we've started off on quite a weak note. It's almost 114 stocks standing to the decline, with just about 27 odd standing to the upside right now. Harsha, almost at the fag end of the Q3 season, from within the mid caps, what are the areas where you feel that there could be a material earnings recovery? Anything from the broader end of the market which you think is worthy of a buy right now?
Clearly, some of the stocks that are exposed to rural economy have done well, and the expectation is they'll continue to do well. We have seen agri prices holding up. We have seen reservoir levels to be high. If we get a good monsoon going forward, and with the kind of push that the government is doing for agri and rural sector in terms of various social schemes, we believe that agri recovery or rural recovery is going to be before urban recovery. So to that extent, some of the sectors which are closely linked to rural economy, for example, agrochemicals, fertilizers, maybe even some of the consumption basket, which has a lot more dependency on rural market than the urban market. These are the areas where we believe there is going to be a faster turnaround as we go ahead. And also we have seen some of the cement names in the mid-cap segment also doing well, given that there is pricing stability, which we already spoke about. So there are pockets even in the broader mid and small cap area where things are turning around. But again, nothing is going to be very, very sharp in any of these areas, and one has to have a lot of patience to make money. So our belief is over the next couple of years, the mid and small caps would deliver better returns than the large cap basket.
Good to have you on the show. Thank you so much for taking the time out and joining in today.